Hello, ladies. Nice to see you again, even if it's only virtually. We're going to be looking at the next chapter 21 in the Theme 1 booklet, Exploring Profit and Loss. And basically, this is the last but one chapter in the Theme 1 booklet, okay? So we're going to be looking specifically at profit and loss, and that's what we're going to cover in this presentation. So first things first then, okay? If you were a business and you entered a market, would you do so if you didn't think that was profitable or going to be profitable? Well, clearly, the answer in most instances would be no, you wouldn't, unless you had a very good reason to do so. But in most instances, a firm is going to be looking to try to make a profit in certainly in the long run. Now, it may well be that in some instances, in the short term, it may accept that it's not going to make a profit, but certainly in the long term, if you are making a loss over a consistent period of time, well, there is only one end for your company, really, and that's financial ruin, essentially. So in some stage, profit is clearly going to be a very important principle, even if you decide that you're going to use that profit to help some ethical cause that you might be involved with, or to help a charity or a good cause of some description. But in this instance, in most instances, there is clearly a requirement to make profit before you can actually then start to support a particular cause. Okay, so let's take a look at profit and loss specifically then in the areas we're going to cover. So the first thing we're going to look at is the profit as an incentive in a competitive market, and we'll also look at market entry and exit. And clearly, there has to be an incentive to enter a market, and more often than not, that is going to be to make a profit and become successful as a business. Also, in some instances, you might need to be considering an exit strategy from that particular market, and clearly, to some degree, whether you're making a profit or not is going to some extent dictate the approach that you might adopt. We're going to look at how firms calculate gross profit, how they calculate operating profit, how you actually calculate profit for the year, which is also known as net profit, and we're also going to look at a statement of comprehensive income, which used to be called a profit and loss account. So if ever you see an income statement or a statement of comprehensive income or a profit and loss account, that basically is one of the same thing. And we'll look at that in a little bit more detail as we go through this presentation. We'll also look at how firms measure profitability, and that involves using some simple ratios. One is the gross profit margin, the second one is the operating profit margin, and the third is the profit for the year, or net profit margin. You'll see that in this instance, not only are we wanting to calculate these key profit figures, but also when we measure profitability, we use the same things that we have calculated in order to demonstrate how well we've done, how well we've been using our resources and allocating our resources in the most efficient way. And then we'll look at how firms can increase profit, and there's a range of things that businesses can do to try to increase profit. So that's the structure of this particular chapter. We're going to look at that in a little bit more detail now. So let's have a look at what profit is then, okay, and some of the things that are going to be used to buy any business to try to encourage more profit, okay? Now, effectively, remember, we've talked about this on umpteen occasions through year one in the course, but any profit is basically the surplus of any revenue once we've considered all of our costs. So basically, if you think about it as total revenue, take away total cost, anything that we got left over is basically profit. And that's the formula that we've just discussed there. So profits equal total cost. No, that's the wrong way around. It should be total revenue minus total cost. So we'll just correct that. Make sure that is around the right way, because otherwise you're going to get very confused. So when we actually calculate, start that one again. When we calculate profit, basically it's total revenue minus total cost, and anything that we got left over is going to give us a profit. There are three types of profit that we're interested in. The first is gross profit, the second is operating profit, and the third is profit for the year. And as we'll see in a minute, when we start to look at an income statement in a bit more detail, this is actually a fairly simple subtraction sum in terms of some of the things that we actually add in to actually see whether we're making a profit, and then some of the things that we take away to see how much profit we've achieved. And as mentioned, these are shown on a statement of comprehensive income, and we'll show how that exactly works in a moment. Okay. Now, what is a statement of comprehensive income, or an income statement, or a profit and loss account? Basically, it's a formal financial document that summarizes the business's activities and expenses and shows whether it's made a profit or a loss. Hence the reason why it's in the past been called a profit and loss account, and it's latterly been known as an income statement, and you can also call it a statement of comprehensive income. And we'll look at that in a little bit more detail now. Okay, so in terms of profit, what is it? Why do people do it? Well, in some ways, profit is a reward for enterprise. So if you are enterprising enough to bring the factors of production together in a certain way that allows you to generate more revenue than it costs you to carry out that activity, then you are actually getting rewarded with a profit. Okay, and clearly that profit can be used however you wish, as if you're the owner of a business. It clearly acts as an incentive in a competitive market. So, and you could argue that it also is to some degree an indicator of how well you've worked within your particular market. So it clearly acts as an incentive in a competitive market. So in some cases, well, businesses clearly are going to be attracted to enter markets if they see that there's an opportunity to make a profit. Now, clearly, if you've been reasonably smart in the way that you looked at markets, etc., you should be able to assess whether you think there is an opportunity for you as a business to make a profit. It might be that you're going to do things in a slightly different way, or you can buy things in a slightly better way than your competition. But in most instances, a business is going to be attracted into a market where they believe there's an opportunity for them to make a profit. If a business can't make a profit in the medium to long run, it is likely to leave that market because clearly you can't sustain a business, you can't be successful in business if you're not making a profit. If your costs are higher than the revenue that you're generating, you're clearly not going to be successful, and you might choose to actually take your business or take the resources that you put into that business and put it into another hopeful source of profit, but you're likely in the medium to long run, if you're not making a profit in that market, you're going to have to leave that market. So let's take a look at in a little bit more detail the way in which we arrive at, or can arrive at, a statement of comprehensive income. Now, if we think about this income statement, and as I mentioned to you before, almost consider it almost as a subtraction sum. Okay, so if we think about the process, first and foremost, in order for us to be able to show the amount of income that we've achieved, then clearly we've got to be able to calculate our sales revenue in the first case. Okay, so that's money that's essentially coming in from sales, and to calculate that, we will take the quantity sold, or the sales volume, and we'll times that by the selling price to get an overall sales revenue figure. Okay, that's the first point. Now, if you think about sales revenue, and then you basically take away the cost of sales, we'll talk about what cost of sales are in a minute, then you will arrive at a gross profit figure. Okay, so that gross profit is essentially sales revenue take away cost of sales. Now, the cost of sales, if you think about the fact that if we're producing a number of watches, okay, let's just assume watches for the moment, then the cost of bringing those watches together, the cost of the raw materials and the labour, etc., is all going to be associated with bringing that product together in the form that it's supposed to be. Okay, so cost of sales are the costs that are directly linked to the production of goods or services that are sold. So it could be the raw materials. It's most likely to be the variable costs. So those things that vary with output. So in this case, raw materials. Clearly, if we're making a watch, then we might need a watch strap, which might be leather. We might need some internal workings, some movements for the watch. We might need some winders, etc., etc. All those things we can actually cost and actually make sure that each one that we use is actually allocated to that particular product, and so you can understand exactly what it's cost you to produce that particular item. Okay, so that's the first stage, so the cost of sales. Now, once we take the cost of sales away from our sales revenue, we arrive at what's known as a gross profit figure. Okay, and that fundamentally, as we said, is sales revenue take away cost of sales. So if you like, what we've done is we've allocated our variable costs, we've allowed for our variable costs in our cost of sales, and we've taken that away from our sales revenue in order to calculate our gross profit. Now, to go to the next stage, to calculate your operating profit, you're then going to take away any other costs, any other operating expenses that were associated with the trading of the business, like salaries or marketing expenditure, and you're going to take that away from your gross profit. Okay, so effectively, what we're doing, if you like, is allowing for our within our cost of sales, we're allowing for our variable costs, and within our operating expenses, we're allowing for our fixed costs. Okay, so effectively, what we're now arrived at to get our operating profit is we've taken our gross profit and taken away that our expenses or our fixed costs from that. So essentially, we've allowed for variable costs in our cost of sales and fixed costs in our expenses. So effectively, we've taken total costs away from our total revenue. And if we've still got anything left over, that is going to leave us with an operating profit. So effectively, we've taken total costs away from our total revenue. Now, there are a couple of other things that we would then need to do in order to calculate the profit for the year. Okay, so once we got to our operating profit figure, we are then going to look at any interest or taxation that we either owe or are owed. Okay, now the interest paid on debt or received on anything that we may have lent to others, or any interest we might have received on some savings, then we're going to add those or take those away from operating profit, and then we're also going to allow for any tax that we might have to pay on the operating profit that we have achieved based on the operations that our organisation have been involved with. Okay, now that is basically not quite it. There's one other thing that we also need to allow for, and that's exceptional items. Okay, so these might be unusually large or infrequent transactions that aren't necessarily part of the main process of producing your goods and services, but those also need to be added back. So it might be more revenue, or it might be more profit that we can add back into that figure. And essentially, what we're doing here is, if we just go back one, sorry, I do apologise, or go forward again one, we then get a profit for the year figure, which is our net profit, which is essentially, again, operating profit. Take away any interest and taxation that we might have owed to arrive at that figure of a profit for the year. Okay, now that doesn't change for any organisation. They might present it in a slightly different way, but fundamentally, a statement of comprehensive income is basically saying is sales revenue, take away cost of sales gives you gross profit, take away other expenses or fixed expenses, let's say, that arrives you at operating profit, and then when you take away interest and taxation and any exceptional items, that allows you to arrive at the net profit or profit for the year. Okay, so let's take a look at an example then, an example of a typical income statement. So in this instance, we've got two elements. We've got the trading account, which we'll look at in a minute, and also the profit and loss account. And fundamentally, exactly the same thing that we just described in terms of the statement of comprehensive income is shown here. So in this instance, we've got sales revenue at £100,000. We've got cost of sales at £45,000. So to calculate our gross profit, we're going to take the £45,000 cost of sales away from our sales revenue to arrive at a gross profit figure of £55,000. So on the face of it, it would appear that we're doing okay. We've made a gross profit of £55,000. However, what we haven't done is allow for any other operating expenses. And in this instance, those other operating expenses amount to £32,000. So again, to calculate our operating profit, we're going to take £32,000, our operating expenses, from the gross profit to arrive at £23,000 worth of operating profit. Then when we look at interest and taxation and our exceptional items, you can see in this instance we've got £6,000 of interest and taxation that we still owe. And when we take that figure away from our operating profit of 23,000, we arrive at a profit for the year, a net profit of £17,000. And that's basically pretty much as complicated as it gets, okay? If you simplify it down, that's fundamentally what an income statement is going to show you, okay? So let's take a look at profitability in a bit more detail now then. Okay, so in this case, what we're doing is we're trying to measure the financial performance of a business, and what we do is compare the profits that we achieve to a second variable. In this case, we compare it to the amount of revenue that we've generated. Okay, so profitability is basically where we look at the amount of profit that we've achieved and compare that to the revenue that we've generated as well. Okay, now there are three profitability ratios that you will need to understand and maybe have to apply in this scenario, and these are basically the gross profit margin, the operating profit margin, and the profit for the year, or net profit margin. Okay, so you've seen those figures before, or you've seen those profits described before: gross profit, operating profit, and profit for the year, or net profit. Okay, and in this case what we're trying to do is look at the margin between what our gross profit figure was and relate it to the revenue, okay, that we generated. So if we're looking at analysing profitability, then let's take a look at how we might use those ratios. Okay, so the first example is our gross profit margin, sometimes known as GPM, and that's where we're looking at the relationship between gross profit and sales revenue. Okay, now in this instance, if we've got gross profit margin that is falling or is lower than we would have ideally liked, it may indicate that a firm has a few issues. Okay, it might not be managing its cost of sale very effectively. It may be that the cost of raw materials are increasing. So if we're actually comparing one figure to another, if our gross profit margin has fallen, it could be down to our cost of sales increasing. It could also be that sales are in decline. Okay, so if gross profit margin has fallen, then sales may actually be, that's another variable that we have to use to calculate gross margin. But if our sales are in decline, that could be another reason for that. Okay, now to calculate the gross profit margin, and obviously you can do this year on year. So if you've got two sets of figures, you can compare one to another. You can compare your gross profit margin to other companies in your market sector. And obviously you can then look at things on a regular basis to see whether you're increasing or decreasing your, in this case, your gross profit margin. To calculate it, basically you take your gross profit, which you get from your income statement, and you divide that by the sales revenue and times it by 100, okay, to give it a percentage. So gross profit margin is always a percentage figure, and in this instance, if we take a look at an example, let's say our sales revenue is £35,000, our cost of sales is £15,750. So in that case, our gross profit figure is £19,250. Where we take our sales revenue, take away our cost of sales of £15,750, and that leaves us with £19,250 of gross profit. Now to calculate the gross profit margin, what we do is basically take our gross profit figure of £19,250, divide it by the £35,000 figure, which was our sales revenue, and times that by 100, and you can see in this case we've got a gross profit margin of 55%. So effectively, 55% of all the sales revenue that we generated is actually gross profit. Okay, and that's quite a healthy gross profit margin to have achieved. Okay. So let's take a look at the next measure, and effectively the operating profit margin and the way in which we calculate the operating profit margin is pretty much exactly the same as we would do so to calculate the gross profit figure or the gross profit margin percentage. But in this case, we're looking at operating profit margin, not gross profit margin. So in this case, if our operating profit margin is low or falling, this can indicate a number of things, okay? One, it may be that if we've got a higher gross profit margin, but a very much lower operating profit margin, it might mean that we're not managing our expenses as effectively as we could have done. Maybe wages are increasing, or we've got overheads or fixed costs that are going up. We've not got control of those fixed costs, which are then eroding our gross profit margin and creating a low operating profit margin. It could again be down to the fact that sales are in decline, and clearly we could look at one set of figures to another set of figures from one time period to another and see whether that is the case. So we'd want to try and look at if there is a problem, seems to be a problem in the operating profit margin, we need to try and investigate the area that we think might be causing the problem in order to try and come up with a set of options and solutions to try to resolve that particular issue. Okay. Now, to calculate the operating profit margin, very similar process that we just talked about for gross profit margin. In this case, we take operating profit margin, divide that by sales revenue, times it by 100. Let's look at an example. So again, we've got the same example in terms of the gross profit margin. We had sales revenue of £35,000. We had a gross profit of 19,250. We've got expenses at 5,950. And so we should be able to then calculate our operating profit by taking the expense figure, the 5,950, away from our gross profit figure of 19,250 to arrive at an operating profit figure of 13,300. Now, to then calculate our operating profit margin, we're going to take our operating profit, divide that by our sales revenue of 35,000, and then times that by 100 to get an operating profit margin of 38%. So you can see that our gross profit margin in this instance was 55%. Our operating profit margin is 28%. So we've had a significant drop from 55% gross margin to an operating profit margin of 38%. And the only thing that has caused that fall is the level of expenses that the business has generated. So clearly, if we're looking at a big fall between gross profit margin and operating profit margin, that is normally down to the expenses being somewhat out of control. Okay. Let's take a look at the next scenario then, where we're actually looking at, in this case, our profit for the year or net profit margin. And again, very similar, but in this case, we're looking at profit for the year and comparing that to our sales revenue and using it to calculate our net profit margin or our profit for the year margin. Okay, now if we've got a profit for the year margin that is low or falling, this could indicate a number of things. One, it could be that gross profit or operating profit are in decline. Two, it may well be that interest rates have changed, which have then caused our expenses to go up and our interest payments after we've calculated our trading details and trading account. Okay, taxation rates may have changed, which might have meant that either taxation has, well, in this case, probably taxation rates have increased, and that means that we're having to pay more tax than we maybe did do last time round. And to calculate that, again, very similar process. We find the profit for the year figure, we divide that by our sales revenue and times it by 100. Now, in this example, we've got our sales revenue at 35,000, we've got our operating profit at 13,300, and we've got interest charges based on our operating profit of 1,950. We've also got taxation that we've had to pay at 2,600. So to calculate our profit for the year, what we would do then is take our 13,300 operating profit and then take away our interest charges and our taxation, which is 1,950 plus the 2,600, and that would leave a profit for the year in this case of 8,750. Now, when we calculate that in terms of our profit for the year margin, we're going to take our profit for the year figure, 8,750, divide that by 35,000, times it by 100, and you can see that our profit for the year margin is 25%. Okay, so those are the three formula that you're going to need to be able to calculate. They're relatively straightforward to calculate, and they are all based on the figures that you would get from an income statement or a statement of comprehensive income or a profit and loss account, whatever term is going to be used. Those three things are basically all the same document. Okay, well, there's a practice question that you can take a look at there. So it's applying some of the principles we've just talked about, but in this case shows Supergroup PLC's comprehensive statement of group income, and you can have a go at calculating the gross profit margin, the operating profit margin, and the profit for the year margin. So I'm going to give a little bit of time to do that. Look back at the notes and the narrated PowerPoint, and also you can refer to page 108 in your booklet for page 21, Exploring Profit and Loss, where it actually shows you in a little bit more detail how to use these ratios to measure profitability on page 111. Okay, so that is what I'd like you to do. I suggest you stop the PowerPoint here and just have a go at completing that and see what figures you arrive at. Now, if we've talked about the issue of profitability and the issue of profits, and clearly one of the things that we want to be doing as a business is looking at ways in which we can improve profits and profitability. And if we decide we're going to use those profits for good, rather than just spending them or keeping them for the organisation, in order for us to be able to make those decisions and maybe support an ethical cause, as we mentioned before, we do need to be able to make profits in order to be able to then distribute those profits in an ethical fashion, if that's what we choose to do. So clearly, any business is going to want to try and improve its profitability. It's often a major aim for a growing business, and you can understand why. Okay, and there's several ways in which this can be achieved. Okay, we could, in this situation, sell the same quantity but at a higher price. Now, that's all well and good if we can get away with that, if our market is going to allow us to sell at a higher price and still have the same demand for that. Now, that obviously might will certainly have or price elasticity of demand will certainly have an effect on that. But in this instance, we could actually achieve this objective of improving profits or profitability by selling the same quantity but at a higher price. We could choose to sell more at the current price, or could try and sell more at the current price. Alternatively, we could sell the same at the same price but reduce costs. So each one of these would actually help us to achieve higher levels of profit. Okay, now clearly all businesses aren't limited just to those options and just to one of those options, but each option is going to have some sort of knock-on effect, and that's clearly one of the things that any business needs to think about. Let's take a look at some other examples of how we might be able to improve profit then. Okay, so we could choose to sell the same amount at a higher price, as we mentioned. Okay, how are we going to do that? Hopefully you might be able to justify to your customers that your product is worth more. Okay, you might demonstrate with case studies or with testimonials that people are going to get lots of further utility and maximize their utility if they choose to buy your particular product at a higher price. Okay, there is a danger, however, you might lose customers if you just increase the price. Okay, what are you going to do if your competitors then change the price that they're charging? How are you going to react to that? Okay, how loyal are your customers? Have you got a brand that is so strong that people will stay loyal almost irrespective of the price that you charge? So that's another question that you might have to ask yourself. Okay, what else might you need to do? You might need to spend more on maintaining a brand image. You might need to advertise more in order to try to widen your target audience, widen the scope of your business, and that obviously comes at a price. Advertising is an expensive process, and in some cases it can definitely be justified, and more often than not, provided it's targeted in the right way, it will have an effect. Let's look at an example then in this scenario. Okay, we currently sell 1,000 units at £45 as our selling price. Okay, so our sales revenue is £45,000. Sounds pretty good, doesn't it? Our cost of sales plus expenses, £35,000. So effectively, that's our total cost. So our operating profit in this instance would be £10,000. Operating profit margin, if we calculate that, we take our operating profit, divide that by our sales revenue, that's going to give us a 22% operating profit margin. Now let's take a look and see if we what would our operating profit margin be if the price was increased to £48, but all the other figures stayed the same. So that clearly is something I'd like you to take a look at and see what difference that would make. But also, I want you to think about when you're trying to calculate that, why might that be difficult to achieve? Now, you might think this is quite simple to achieve, but in this instance, think about what might or might not allow you to do that. And that might be based on some of the questions that we posed ourselves earlier on in the slide, okay? Let's take a look at the other things that we can do then. Sell more at the current price. That's another alternative that we can look at. How are we going to do that? Again, are we going to gain new customers? Because if we're going to sell more at the current price, we've clearly got to promote to more people, maybe look for a new audience that is going to buy our product so that we can actually generate more sales, create more sales volume. How are you going to attract them from your competitors? What are your competitors like? Are we doing things better than our competitors? Can we justify why somebody might swap or substitute from a competitor's product to your product, okay? Are there new markets that you can enter? Can you diversify in some way? Can you find a new market for your existing product? Again, that might sound like a relatively easy process to go through, but sometimes it's not as straightforward as it might seem. Will you have to spend more money on marketing? Well, almost inevitably you would have to, I think, if you were going to try to sell more at your current price, because clearly one of the ways in which you would do that is to widen the appeal of your product, but also keep your brand awareness and your product and brand out there in front of your potential customers and your existing customers. Could you encourage your existing customers to buy more? Could you do a buy one, get one free, for instance? Or could you create some sort of incentive, some sort of sales promotion that is going to encourage existing customers to buy more? And again, think about why some of those things might be difficult to achieve. It's not so much what we know we can control certain things that are within our power. So they are internal factors, but clearly external factors like what your competition is doing, like the state of the market, there's very little that you can do about that. And when I say the state of the market, I mean in terms of the economic cycle. Are we in an expansionary phase, or are we about to go into some form of recession? That clearly is going to have an effect on attempting to improve profits and profitability in this way. Let's take a look at the third option then, selling the same at the same price, but to cut costs. Now, clearly in this instance, we're keeping our revenue at the same level. Both the other options that we've looked at previously were about increasing overall total revenue, okay? In this instance, we're saying we're going to sell the same at the same price, so our revenue will stay the same, but we then cut costs. How are we going to do that? Now, clearly, one of the things that we've got to do is consider, if we cut costs, is that going to affect the quality of the overall product, and will we lose customers if we change the quality of the product or the raw materials that we're using to go for a cheaper option? Clearly, if quality is affected, then that might actually cause your image and your brand image to be tarnished. And that clearly might then mean that some customers might choose to walk away from you. They might choose to substitute your product for another one. Now, other ways in which you could also do that is to look at your operational efficiency. How can you make your production activities more operationally efficient? Okay, now that again, if we can improve operational efficiency and reduce our cost of production, our unit cost of production, then in that case that would be an achievable thing. However, there are certain things that are, again, going to stop you from doing that, and that might be competitor actions, it might be a whole range of things. It might be to do with suppliers who aren't willing to cut costs or provide you with products and services at a cheaper price in order for you to then cut costs of production for your organisation. Okay, so other things that we can do as well, and this is something that is definitely worth considering, is looking at profitability by industry. Certain industries are much more profitable than others, and one of the things that you can do is to benchmark your organisation against others within your industry, but in some instances against other industries too, to see whether you are doing well, where your profit margins are in comparison to others. And in this instance, clearly, there are a number of things that are going to then influence a business's ability to achieve higher levels of profit. So a little bit of research required here, and just to be familiar with the different levels of profitability within different industries. So a little activity for you to consider there. Another activity, which again is something that I'd like you to consider, and maybe we can discuss when we come to our next tutorial, is this GladRags activity. Okay, so in this instance, we've got a short narrative which describes a little bit about Gladys, who's running a small boutique selling ladies' fashion in an exclusive shopping mall in Chester. Okay, so all the wags and the wives and girlfriends of the Manchester United crowd and Man City crowd all tend to live in Old Edge, which I think is near Chester, isn't it? So in this instance, we've got rising rents, we've got increased competition, we've got a whole scenario going on, which means that Gladys's GladRags are suffering a bit. They're not making the profits that they would like to make, and Gladys is going to have to do something to try and improve that. Now, in this instance, there are 4 or 5 examples of the things that she might be able to do, and she has asked us as business advisors to come up with some views on what these actions are, what the best actions are, and to report on the strengths and weaknesses of each action before making a final recommendation. So what I'd like you to do is, using the information that we've gone through and this activity, is have a go at coming up with some final recommendations, and that's something that we'll discuss at the next tutorial, which will be later on this week. Okay, so thanks for listening, girls. Hopefully it's all made sense. Obviously, again, if you've got any questions on any of the things that we've looked at here, please shout. You can contact me via Teams or via email. And obviously we can talk about that at the next tutorial too. So thanks for your attention, and I'll catch up with you next time.